Hi, welcome back. You're watching Trading Hour. Let's invite Unmesh Sharma of HDFC Securities, who joins in now to talk about the market fundamentals and, of course, where do you put your money? Hi, Unmesh. Thanks very much for joining in. The global setup is, it has been volatile, right, for some time now. No surprises there. But how much worse can things get from here? And in terms of impact for India, what are you betting on in terms of, where allocation should be? How much can volatility spike from here? Should you move to cash? What is your house view now?
Okay, so look, volatility has been high. We don't see that changing. In fact, if you see what's been going on, what we have been expressing not on this channel as well for the last 2 or 3 months is that we saw a false dawn, so as to speak, in September, when there was a view that there has been a dovish pivot by the Fed. We always thought that that was not going to last, so it's played out that way. To some extent, the markets come off, so it's a good thing. But having said that, we believe there are two very important factors. One is that the volatility will persist. The central banks globally, if you look at what's happening between Japan, China, EU facing its own problems with central banks as well as governments, as well as the Federal Reserve, and of course, eventually India, very different drivers. So the coordination of central banks, which had become something that the market had taken for granted since 2008 after the fight against the global credit crisis, is something which is broken down. Now, in that case, what happens is that every time someone says something, volatility comes back into the market, and we can't see that change because the inflationary pressures also on different countries is different at this point in time due to various geopolitical and other factors. So will that change? We think not. The good thing is that the market was well over one standard deviation, maybe at around 18.5. What we are currently seeing is that it's cooled off a bit. But at the same point in time, if you look at the number of imponderables that are there in the market, usually you are comfortable investing, when you can actually start thumping the table is really one standard deviation below. Now, that may be a fair distance. So the correction in our view is not over. We continue to believe this will go on, but it will also not be a straight line, because there is no dislocation in the global market. So what will happen is that it will be a slow grind downwards, we believe, which we believe will continue.
All right. Hi, Unmesh. Good morning, and thanks for joining us. This is Pavitra. So, in this situation, then, what are the sectors where you feel you're perhaps most comfortable putting some fresh money to play? Financials have been a sector which have, been favored for a while now. Do you think that is still a good bet?
Yes, indeed. So, to answer also part of the earlier question, we work for institutional equities. We don't believe in actually sitting in too much cash. So if you look at our model portfolio, it has 3% cash today. I don't expect that to go up significantly. We've held a little bit more for short periods of time, but really that's where we continue to believe. We believe the way to invest in this is twofold. The first thing to keep in mind is that we believe that whatever we are going through is basically the action by the Federal Reserve to induce a shallow recession to achieve price stability. Okay. In that context, this is not like 2001 or 2008 or even 2020, where we believe that there will be a very serious contagion spreading from financial markets into the economy. So we are looking at a normal kind of cycle, maybe a long grind maybe towards it, maybe for the next 12 to 18 months, but that's what will happen. In that context, the best way to invest your money is to invest in thematics. Now, how do we do that? Our model portfolio has two very strong calls. One is that we prefer value. And the second is the big call that our research team has taken is industrials over consumer. And which is why, and all the derivatives of that. So what you will notice is that our largest overweights are large banks, industrials companies, real estate, and then there are thematics, which we believe will continue to play out through this entire period. So financial inclusion, which can be played through insurance or capital markets. We have the city gas players, and we believe that the ancillary benefits of all of this, which is the cement sector. So that's basically where we are investing at this point in time.
Okay, Unmesh, you also said, you're looking at value. Then at a time like this, when a lot of the IT stocks have corrected 40-50% from the peak, does that space also seem attractive to you? Or do you think that, there is maybe room for a lot more of a fall and there could be a better time to get in?
Yeah, so you're right. That's a tough one because of the, so there are two issues here, right? The currency, thankfully, is not creating a problem for them, not at this time. What you do have is that, we have a large research team. Apur's written a very good report on the demand drivers for IT. In our model portfolio, given the valuations, we have been around 200 to 220 bips underweight now for a while. Okay. And that's to some extent played out quite well. But if you look at the longer term drivers, we are quite confident that, the adoption of cloud digitization and, the larger themes within that, the fact that the Indian companies are slowly climbing the value chain. Would you want to remain invested in the space? The answer is yes. Is it an overweight at this point in time? Answer is no. What we are doing is that, and relatively we have a call of Infosys over TCS, which is the relative weight that we have in the model portfolio. So we are very selective. We believe that we should start looking at the space, incrementally put money to use. But so while we have held an underweight stance, we believe that the correction in valuation and the fact that we have fairly good visibility on the longer term drivers. So we are very confident that 3 years from now, it will be a good call to have taken. Maybe from a timing perspective, you could get it a bit more right, but we are positive on the IT space in that sense.
Okay, just one final question. You were saying you're positive on the IT space. One final question I want to ask you is on the metals pack as well. We have seen a decline there, of course, after a big run-up as well. But the commodities are a whole different play, right? Do you have a call in the metal space as well?
No, we are underweight. We did miss a part of the rally, of course, but at the same point in time, we are underweight. We're quite comfortable doing that. We believe the easiest way to look at that is that the two key drivers usually for metals is one is the financialization, because to a large extent they are risk assets now, usually clubbed with emerging markets, and we believe that we are in a risk-off environment. We believe that will continue. So that's one very big negative from that perspective. And the second is, if you look at the demand drivers, right? The only risk to our call really is whether when China opens up, what happens, because right now obviously there's a lockdown ongoing over there, but that could be a short-term rally. If you look at structurally, there has been a fair bit of demand destruction where globally the larger countries seem to be wanting to slow down their economy. So in that sense, while we do have some names in our model portfolio, I think we have Hindalco, Tata Steel in there, but they are all underweight. They are all underweight positions, and we're quite comfortable with that.
Underweight on the metals. Unmesh, thanks a lot for joining us today and taking us through your call in the market as well as all of these individual sectors. So they do like some of the industrials, some of the financials such as the larger banks, and some select IT names as well, but they're underweight on the metals pack. So with that, we're going to get into a short break now. But as we do that, here are some great news for our investors.